Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why home improvement has been resilient at the retailer Home Depot.
And we'll discuss why the tech giant Apple still hasn't managed to crack AI.
But first, we begin with earnings from the retailer Target.
This week, Target reported sales that dropped in the first quarter, and the company also cut its sales forecast for the year.
Target cited declining consumer spending, along with the impact of tariffs and boycotts.
Target shares fell after the report and raised some questions over the company's ability to recapture growth after 2 years of choppy results.
For more, we were joined by Jennifer Bartashus, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food.
We first asked Jennifer if she was surprised by the results.
None of this really was a surprise. It's really about the degree to which it was a surprise. So sales came in softer than expected. Profit was a little softer than expected. And it's just, I think people are waiting for Target to say how they're going to fix it. And, they came out talking about a new office, to accelerate their plans. But I think people are just waiting for something tangible that they can really hold the company accountable for to reignite growth in what they're trying to do.
What does Target need to do specifically? Because it seems like, I don't know, every time I walk into a Target, it's lots of people doing stuff. The shelves are in good shape. What do they need to do?
Well, a lot of it is continuing what they've started, which is improving their merchandise mix. Target does best when their assortment is new, it's fresh, it's relevant to people, and they've made good strides in that area. But those types of changes take time for consumers to see and to start to embrace. And it's just a hard environment where people are still being a little bit conservative for those changes to really create some momentum in the business.
So where are they with the pricing stuff in terms of their inventory, in terms of tariffs, in terms of where they source their material?
Yeah, so from a pricing perspective, when people look at value, price is one of the first things they look at. They're fairly price competitive, and we've seen an uptick in the number of promotions that they're doing. So, buy $40 of these kinds of essentials and get a $5 gift card. They're doing a lot more of that kind of promotion to pull people in. But one of the issues is that they talked today about inventory and having to, adjust and right-size their inventory. And that's a little bit concerning because that's been a topic that it's not new for Target. It's come up a couple of times in the past few years. And so the fact that they are expecting, some inventory adjustments and markdowns to weigh on margins and profit, for the next quarter is a little bit concerning that they still haven't quite figured out how they're going to navigate that.
Jen, I know Walmart said on there recently that they would pass along probably some of their tariff-related cost increases to consumers, and then President Trump came out pretty publicly against that. What is Target saying about their ability to take whatever price increases, cost increases may come about through tariffs, either in their margin or passing it along to consumers?
Yeah, it's definitely a good topic, Paul. And what they said was that price increases would be the last resort, but they didn't count them out. Instead, they focused on the tactics that he can use to try to mitigate some of the pressure from tariffs. They're the same levers that every company is pulling. It's using your scale. It's working with your suppliers. It's trying to negotiate better, better sourcing and better prices on the purchasing side. So, Target is certainly able to offset some of the cost of tariffs, but it would be surprising if they can offset all of it. And ultimately, there's most likely going to have to be some selective price increases that get pushed through.
What's their inventory like in terms of that part and how that filters into their pricing?
Yeah, so inventory has actually been getting a little bit better in terms of on-shelf availability and tracking through the supply chain. It's just, I think because they skew so much more to discretionary, if there's, like, for example, in first quarter, we had some very unseasonably cold weather. That impacts apparel sales. That impacts a lot of those things. So, that increases markdowns. Hopefully, that's a transitory type of thing. But they are talking about getting their inventory right-sized as they head into back to school and the holiday season.
Hey, Jen, this stock seems cheap to me. Is it cheap on a historical basis, or how are people thinking about valuation?
Yeah, it's definitely, at a discount from a historical, valuation perspective. But I think part of the reason that it is where it is that for a long time, what has differentiated Target was their private label selection, their own brands, things that the quality of those brands where people could get value and style at a really compelling price. In the last couple of years, a lot of their competitors, whether you're talking about Walmart or Kohl's or companies like that, have invested in their private label. They've improved the quality. They've become a little bit more fashion forward, and that erodes the differentiation that Target has always enjoyed, and part of what has catapulted their success in recent years. So until Target gets that newness and that assortment readjusted again to be a leader and a differentiator, you may see that kind of valuation discount persist.
All right, thanks to Jen Bartashus, Bloomberg Intelligence Senior Retail Analyst.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at how the cost of clean energy technologies has changed. Solar and wind have been the most competitive source of new power for a few years now.
And for more, we are joined by Amar Vast Dev, BNEF lead levelized cost expert. We first asked Amar to break down his research and what his team actually does.
Effectively, we collect cost data on recently financed power projects, and we sum that up into a metric that we call the levelized cost of electricity. And in short, what that is it tells us what the long-term offtake price is that project developer needs to hit their IRR, recoup all of their costs, and of course pay the taxes.
So, Amara, here's what I don't think people understand, and I did not understand it until recently, that renewables are the cheapest source to meet new demand almost everywhere. Talk to us about that.
Yeah, so the cost reductions in renewable technology, so specifically wind and solar, have been quite remarkable over the last decade or so. And so when we look at those projects that were financed last year and we estimate those costs, we find that either wind or solar is outcompeting either coal or gas in markets that are equivalent to 2/3 of global power generation. So that includes China, includes most of Europe as well.
But we take into account the intermittent power issue for wind and solar, and how does that change the cost profile? Like, it might be cheaper to build a wind farm than building a nuclear plant, but the intermittent power of it all is an issue.
Yeah, that is definitely right. It is a problem with renewables that is often cited, but there are supporting technologies for supporting a grid that is dominated by wind and solar. And that would be battery storage, for example. And so if we look last year alone, the cost of the typical project fell by 1/3. And out to 2035, we estimate that the cost of battery storage projects fall by 50%. So there are supporting technologies that pair with wind and solar. And we also model, we look at these costs, we break them down, and we look at the view out to 2050, how different power markets are likely to change. And just to put that in context, when we take that system view, we see that there are really strong long-term fundamentals for renewables. So today, wind and solar are around 8% of generation, and that increases to 60% in our modeling by 2050. And at the same time, the flip side of that is with fossil fuel assets, so coal and gas plants. Today, they're at 60%. But by 2050, they go down to 25%. And what they do is they kind of operate in a space where they support wind and solar as well as battery storage.
So thinking just in the near term, what do high tariffs and maybe possible cuts to tax credits, what does that mean for this transition? Does it slow it down materially, possibly?
Yeah, it is a really interesting question, and it's, as you know, it's moving very quickly. So our team in the US are tracking this very, very closely. And what we can say is the policy and tariff uncertainty is posing a challenge for business confidence. It kind of impacts the willingness and investor appetite. But we do see that there is resilient demand, deployment stays resilient over the next 10 years or so, because we do see increased electricity demand from AI, needs for manufacturing as well. And what tends to be the cheapest source of electricity is wind and solar. So there is resilient deployment. We did model a scenario where if tax credits were cut, the amount of wind and solar being added over the next 10 years would reduce by around 17% or so. So there is a material impact. But if we're adding new if we're adding new supply to the grid, then it would tend to come from wind and solar.
What about geothermal? The administration is definitely positive on geothermal. In speaking with the energy secretary here, he speaks a lot about that, as well as clean coal. What's the cost profile like for geothermal?
Yeah, it's hard for me to comment on that. I think the configuration of geothermal changes significantly. But there have been developments recently, and I suppose with the pairing with the kind of coupling with oil and gas experience with geothermal, there's a lot of overlap there. On the specific costs, I couldn't comment on.
Our thanks to Amar Vast Dev, BNEF lead levelized cost expert.
Coming up, we're going to look at why cancer risks are being linked to a popular over-the-counter drug.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to news from the world's largest home improvement retailer, Home Depot.
This week, Home Depot maintained its guidance for their fiscal year as U.S. sales ticked up.
The company said consumers are deferring larger projects due to the rate environment, but are still taking on smaller home projects.
For more, we were joined by Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
We first asked Drew for his take on why home improvement has been so resilient at Home Depot.
One of the reasons why home improvement and Home Depot have been so resilient is because a large portion of the industry has to do with that maintenance and repair-oriented work. So I think that's where they're seeing a lot of the lift now. It's homeowners who are taking care of the things that they need to just to maintain their home. This really isn't new. It's been a couple of quarters now where we've heard from them that big ticket discretionary categories have been relatively weaker. So think about things like kitchen remodels, bath remodels, flooring projects. These are things that tend to be financed by the consumer. And with rates as high as they are right now, it's just become a little bit prohibitive for them to undertake those projects. So I think in order to see more robust growth out of these categories, which is really the missing piece of the story, we need to see rates start to come back down a little bit.
How about tariffs? Is that impacting the cost of their goods, like getting lumber from Canada, for example?
So we think Home Depot is pretty well positioned from a tariff perspective. They source about 50% of the products they sell from inside the U.S. And, like a lot of other retailers over the last decade, they've done a great job in diversifying their supply chain. They actually said that over the next 12 months, no single country outside of the U.S. is going to account for more than 10% of their product purchases. So the fact that they're diversifying their supply chain should help with costs. At the same time, given their scale, the largest home improvement retailer, they'll have the ability to push back on some of their suppliers in terms of cost. Now, what they said is that they're looking to generally maintain their prices. So I think people took that as a positive. You have to remember, Home Depot sells about 30,000 to 40,000 products in their store. So when they talk about pricing, they take a portfolio approach. So you may not see them raise the price on a particular item that was tariffed, but they look at the elasticities of their various products and they'll take price as they need to where they can.
Gotcha. So they're going to manage that margin. So they're not going to sacrifice margin then.
So they actually guided to an operating margin pretty much in line with what they were looking for at the end of last quarter. There are a couple puts and takes. They're doing better on shrink, so they're managing their retail theft a little better, which is always a positive. So they're also, getting some more leverage from productivity. So, I think pricing is going to be a component of it, but they also have other levers within the business that are going to help to maintain their margins, where they expected them.
What's Home Depot do with the number of stores? Have they added stores? Are they fully kind of where they want to be? What's the store count story?
Yeah, so interestingly, Home Depot over the last year has actually returned to store growth, which is something we haven't seen from them in a very long time. They kind of had the established footprint in the U.S., but as the business has grown so much, as they've grown their pro business, they've started to add new stores in markets where populations are growing or where they want to kind of take some of the pressure off the existing store base to look to drive some additional productivity. So this year they're adding about 13 new stores. They're going to do that. I think their plan was about 80 over a 5-year period. So the next couple of years they'll continue to add new units.
Our thanks to Drew Redding, Bloomberg Intelligence U.S. homebuilding analyst.
We move next to earnings from the off-price retailer TJX.
TJX reported a gross margin shortfall for its first quarter and issued full-year guidance that fell short of analyst expectations.
However, the company said its global network of vendors and flexibility on prices will help it manage future tariff pressures.
For more, we were joined by Mary Ross Gilbert, a Bloomberg Intelligence senior equity analyst covering retail.
We first asked Mary for her key takeaways from TJX's results.
So when I look at the results, they beat, for the quarter. They beat on the top line, for total sales, and they came in line on comp sales being up 3%. And that was at the high end of their guidance. The real issue, I think, is the forward guidance. So when you look at the second quarter, analysts were looking for EPS of about $1.04. And the top end of their guidance, it's 97 cents to $1. And so I think there's a disappointment there, but frankly, this management team really executes. They tend to provide conservative guidance. So we really view this as whatever guidance they put out there, we see upside to it. They certainly have seen a strong start to the second quarter. Concerns around tariffs, they're saying that they can mostly mitigate most of the impact when it comes to directly sourced merchandise. And then with regard to indirectly sourced merchandise, this is where they're buying, overstocks. They'll be able to negotiate. They see plenty of availability, and so they see a lot of opportunity in terms of the buying there, and they'll make sure that they always maintain that gap, and that gap being 20 to 60% versus what you'd see at department and specialty store.
Oh, I know.
Oh, yes.
I was telling these guys that I feel like I'm single-handedly keeping home goods in business, having to furnish a house.
Who is the TJX consumer other than Alix Steele and Lisa Mateo, who I know? Who is that consumer? Who is that customer? And what's the company saying about their customer?
So, Paul, TJ Maxx's customer, Marmaxx and Home Goods, it spans from low income all the way up to high income. So within the Marmaxx, which is where you have TJ Maxx and Marshalls, they carry brands as high as Gucci, Fendi, Chloe, you name it. And we see a lot of that merchandise there. They have stores where you can walk in and you'll see these high-end handbags in glass cases, just like you would in a department store where it's really tethered. And so they have that as well. But then they also have, more moderate brands like a Tommy Hilfiger and a Calvin Klein, or Juicy Couture, even, at a lower end there. So they're able to attract all income levels, and they know how to merchandise their stores appropriately all around the country and actually all around the world, because we're seeing strength in all of their markets. And you raised a good point, Alix. I think you talked about Home Goods, and you're absolutely right. Home Goods actually led the comps. They were up 4%. And so when you look at the comps that were at Marmaxx, they were up 2%. So they definitely saw strength in Home Goods.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence senior equity analyst covering retail.
This week, we focused on the Bloomberg Bigtake story titled Possible Cancer Health Risks Are Lurking in a Popular OTC Drug, and you can find it on Bloomberg.com and in the terminal.
The story looks at the dangers of a widely available drug for urinary tract infections, that has never been formally approved by the U.S. government, and it's not the only one.
For more, we were joined by the story's author, Anna Edney, Bloomberg national healthcare reporter. And we first asked Anna to walk us through some of the over-the-counter drugs discussed in the story.
Probably the most popular one, I think a lot of our listeners will recognize, is Azo. It's an over-the-counter drug, so you can go into most any store, Target, Walmart, anything like that, and purchase it. You don't need a prescription. Urostat is another brand, but all of these stores also make their own generic version. So it's something that is supposed to treat the pain with urinary tract infections. A lot of people seem to think it goes beyond that, and it's actually curing their infection. So one of the issues being that people might need antibiotics, but instead they're using this.
Now, what's the drug in it that is causing some of the issues, and how do we know?
Yeah, so this is the active ingredient in all of these drugs. It's what the generics will go by. It's called phenazopyridine. I may still be butchering that name, but it's an unapproved drug, which was really interesting to me, and something sort of new to me, even though I've covered these issues for a long time, that I came across. What it means is the FDA has never formally approved this drug. So, while millions of women are using it for decades, there's never been a true vetting of, how this drug interacts with our bodies. One of the things that a National Cancer Institute study found, this was back in 1978, is that it caused tumors to form in rats and mice. That's never been looked at in humans because this drug has never gone through clinical trials. Wow. or anything like that.
That is just, that statement is so insane. And Paul, just I'll explain to you a little bit here. So if you have a UTI, it comes on really fast. And if you order to get medication from your doctor or gynecologist, you have to go in so they can test it. And if you're in pain and you know what it is because you've had it before, you just go to the store, pick it up, and you feel better in 24 hours. That's why these drugs are so popular and easy to access. And
what I learned in Anna's story, Anna, they're not FDA approved. They are essentially grandfathered in. So if I'm walking down the aisle looking at, over-the-counter drugs, do I have any way of knowing what's been FDA approved and maybe what hasn't been?
Yeah, I think that's a really good question. And there were multiple quotes out there from congressional testimony and other places where FDA staff members were talking about there are many such grandfathered in kind of drugs, but the agency did not give me a list, wouldn't even tell me how many might be out there. But there is potentially, this takes a little sleuthing. It's not that easy to do in the drugstore aisle, but there's a website that the National Institutes of Health runs called Daily Med, and people can search by drug there. I wouldn't say it's like the most user-friendly looking piece, but if you look for Azo or Urostat or phenazopyridine, any of those, what will come up is kind of a disclaimer saying, this hasn't been vetted by the Food and Drug Administration, its safety is not known. And that kind of gives you an indication. You can dive deeper into that data and you can actually see that it's unapproved, but just for the layperson, at least with that disclaimer, that would give you a good idea at the top.
So what happens now?
I think that's a good question. So the FDA they have a system where they're supposed to have vetted these kind of very old drugs and given them what's called a monograph. This is the agency's instruction book. Here's how this drug should be made. Here's how the dosing, what it should be. Here's how it should be manufactured. They have not done that for phenazopyridine. So it's possible that, with this increased attention, that they could decide to look into that. They asked in 2003 whether this drug should actually be prescription only, just given the risks, and that people don't often follow directions on OTC drugs. You're only supposed to take this for 2 days, and you're not supposed to take it all the time. There are companies, particularly online retailers, that are really pushing this drug on women and girls kind of just to have on hand all the time.
Our thanks to Anna Edney, Bloomberg National Healthcare Reporter.
Coming up on the program, we're going to look at how diversity, equity, and inclusion, DEI efforts have changed at U.S. companies.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This week, we focused on a Bloomberg Bigtake story titled Apple Spending Billions and Still Hasn't Managed to Crack AI. You can find it on Bloomberg.com and the terminal.
The story looks at Apple's continued failure to get artificial intelligence right. And it discusses how this threatens everything from the iPhone's dominance to plans for robots and other products.
For more, we are joined by the story's author, Mark Gurman, Bloomberg News managing editor for Global Consumer Tech.
We first asked Mark about what's going on at Cupertino as it relates to AI.
Well, philosophical differences, mismanagement, and the biggest thing is they were blindsided when generative AI with ChatGPT and GitHub launched back in 2022, November 2022. I'm told Apple Intelligence wasn't even an idea back then.
Why?
Well, they missed the boat.
But how? I mean, I don't understand. Yeah.
Well, clearly there was philosophical disagreement and philosophical disinterest in the topic of artificial intelligence. I write about how Craig Federighi, Apple's senior VP of software engineering, doesn't really believe in these multi-billion-dollar projects. He tends to try to shut down or steer away from projects of that sort. And AI is something of that nature. AI is quite a bit messy. They're known for their very intricate and well-designed user experiences. AI, sometimes with hallucinations, can take away from that. But I think they didn't think it was going to be as big of a thing as it became today. A lot of it fell on deaf ears years ago, I'm told. But really, this is a company that's known for updating their operating systems once a year. It's known as a company that focuses on the minutia, and they missed the big picture here with artificial intelligence, and it really is a shame. You know, the big picture here isn't the AI capabilities of its devices today. The big picture today is the AI capability of future hardware. If you don't have the core technology, the AI ready to go at a deep level, how are you going to develop products like humanoid robots, smart glasses, watches and AirPods with depth sensing cameras for AI purposes? Can't do any of that if you don't have that technology. So they need to seriously turn this thing around quickly, or they're going to be in big trouble. This is as core a technology as the touchscreen.
Wow.
I mean, first of all, how many words is this story, dude?
6,000.
Yeah, this is a long,
Whoa.
well in-depth story, folks. So if you want to get smart on AI and Apple, you got to read the story. It's in the Bloomberg Business Week. It's on the terminal. I'm sure it's everywhere else as well. Mark, what can they do? If I'm an investor, that's the only question I have for Tim Cook. Can you guys catch up and get some of that AI pixie dust in your stock?
Yes, they need to make acquisitions, and they need to up the percentage of that R&D budget tied to AI. They need to up that percentage. They need to allocate more of their hires to AI as well. So they need to go big or go home on this. And I think...
Do they know that, do you think?
Yeah, of course they know that.
Okay.
How do they go big?
You got to spend more money. AI is really one of the only things that you can buy your way into when it comes to this technology, right? You can buy your way into it. You just need to throw billions and billions at AI training. They need to make probably some tweaks to their privacy policy, right? They have so many devices. They have more devices than anyone else as a single brand of a hardware company, of any company in the entire world, in the history of the world. But they don't leverage that because of their privacy stance. So maybe make some tweaks there to be able to collect some more data. Maybe figure out a way to convince people to give up some of their data for this purpose. And I think that could go a long way for them. So spending money, collecting more data.
Is there somebody out there that they could buy, should buy, that would leapfrog them, do you think?
They hate doing that though, right?
Well, the problem is this philosophical disgust, I would say, to making these large acquisitions. If I told you, I mean, you know this is true, so maybe you're not a good example, but if I said to someone who didn't know the company as well as you two, would you believe me if I told you that Apple's biggest acquisition in the history of the company was $3 billion?
I actually believe that.
Well, you believe that because you know that. But I think if you ask people who didn't know that, that would be completely unbelievable. They make these small acquisitions. And in addition to not wanting to spend big bucks on a company, they're really poor at integrating companies. The Beats integration, integrating all those engineers into the company, disaster. Intel, they bought the modem unit for $1 billion back in 19, disaster. What is it going to feel as an AI person at Apple today if the company buys your replacement to bring them in? It's not going to be fun. There's enough turf wars as it is at Apple. So
if they do then have to do it internally, they've still not done well at that.
They've got to do both. They got to make the acquisition. They got to just deal with that. They got to make their biggest acquisition ever, and it has to be for AI, maybe multiple acquisitions. They have to turn things up a notch internally as well. They're going to be making changes. I mean, there's so many philosophical disagreements. The biggest is about chatbots when it comes to AI. They are allergic to AI chatbots. They don't like the technology. They don't think OpenAI has staying power. So yes, I know.
I made a face when he said that, by the way. Okay.
You're going to see deeper integrations with other companies. You're going to see Google Gemini integration. I think next year you'll see Perplexity integration, maybe some Anthropic integration, maybe some Microsoft integration, but they're going to keep pushing, and this is going to be a multi-year thing. The biggest problem is they were caught off guard when this happened, so they had no head start on this. They're coming way from behind.
Yeah, it's amazing. Now, some people would say, hey, they're rarely first phones. But
That's
boy,
true.
when they decide to get into phones, they do it
That's
really well.
the big difference. They were not first, and they're the worst.
Our thanks to Mark Gurman, Bloomberg News Managing Editor for Global Consumer Tech.
This week, we focused on a story on the Bloomberg Terminal and Bloomberg.com entitled, Despite Backlash, DEI Hasn't Disappeared at U.S. Companies.
It discusses how Walmart and other large U.S. companies have made modest changes to their diversity, equity, and inclusion efforts, but most programs retain intact with minor adjustments.
For more, we were joined by the story's author, Simone Foxman, reporter for the Bloomberg News Equality Team. We first asked Simone to break down what she's learned recently about DEI at U.S. companies.
Well, frankly, I've been talking to senior executives at large companies, their corporate advisors, ever since Trump's executive orders came out on January 21st. And the message I've been hearing is no. Frankly, many of the programs that were part of diversity, equity, and inclusion, many of which had frankly been around since long before the acronym even existed, they're still there. They've had some tweaks, maybe, and we can talk about exactly what those are. But companies still believe that these underlying programs, the ones that will help them recruit diverse talent, as well as keep employees happy, these are largely there. And so, even at companies that have sort of tried to send a message to their to perhaps the Trump administration, perhaps conservative activists, they're sending a very different message to their employees and investors.
Well, I think what got a lot of people's attention, including myself, was when Walmart came out and said they're going to scale back DEI. I mean, it's like a monster employer all over the country. What did you find at Walmart?
I mean, even when that announcement came out, which was just before Black Friday, if you looked into the actual depth of what they were talking about, sunsetting the term DEI in favor of belonging, these aren't huge, enormous things. A racial equity training that they had in conjunction with Racial Equity Institute, it hadn't been offered since the spring of that year, and that was something that they said, okay, well, we're not going to have this anymore. In fact, Walmart's still mentioning in its job postings that they want associates who are committed to diversity, equity, and inclusion. Spokesman told us that they're trying to phase out that language in posts, and some people call different names. But
what are the names? Like, what are the kind of things that people are now sort of spitting out there?
I mean, it depends company by company. At Walmart, supplier diversity became supplier inclusion, for example, and there were some small tweaks to their supplier diversity program, not just focusing on race and gender in terms of trying to find diverse suppliers, but they're absolutely still highlighting brands that are owned by women, Hispanic people, Black people, it's LGBTQIA plus people. These, in fact, all have landing pages. So it clearly speaks to the idea that consumers want this. They're looking for brands, or Walmart believes they're looking for these brands. So maybe that's not somewhere where they really pull back. Does that satisfy the Trump administration, conservative activists, et cetera? Maybe, maybe not. I will say one thing as well that was very controversial were sort of demographic targets. For example, we want to double the number of women in senior management roles by 2026. That target very specific target, lawyers are advising companies that this sounds a little bit too much like a quota, so don't have that anymore. Or if I guess the lawyers are saying don't have that, at best, companies are not having that publicly. Because that is a little bit of that legal gray area, not sorted out by the court, but something, even a voluntary target that lawyers say, you might want to stay away from that.
I sort of remember, talking about internships, mentor programs that help marginalized groups, and maybe, talking about hiring in historically black colleges and universities. Is that under pressure, or is that going to be changing? So
those are actually two different things.
Okay.
One, mentorships and internship programs have now been opened to everyone.
Everybody, okay.
And this is sort of another thing that was recommended by lawyers, came in, especially after the Students for Fair Admissions at Harvard decision. HBCU scholarships, however, if recruiting from a specific HBCU, historically black college and university, these are actually still getting a lot of interest from companies because there is something that is extremely legally above board. Anyone can apply to go to an HBCU, and a company can choose to hire or to have a scholarship or internship program specifically targeted towards an HBCU. And because anyone can go there, that means they're definitely not, discriminating on race from a legal perspective. And frankly, among conservative groups, this is a little bit of a bone. It's a little bit of a kind of subject of controversy because these are, HBCU programs are the ones that feel like DEI at its very heart. And frankly, they were the way to try and increase the pipeline of black managers and black engineers and technologists and et cetera. So we'll see if there's more attacks on those specific programs going forward. At the moment, that seems to be a legal area where, many companies are doing.
Do you get the sense from many companies that there is a worry about going too far in the other direction? Like stripping out certain things that actually need to be thought of and done?
100%. Absolutely. And, when you talk to a senior executive at an accounting firm was telling me they just need accountants. They cannot get accountants unless they are going to places where people have not been exposed to accounting to try and encourage them to work for them. They don't want to make young people unhappy. These are affinity groups, employee resource groups still exist in part. Maybe there's scrutiny of their spending, but they still exist a lot because this is stuff that makes people happy to come to work. And companies are very afraid because the actual employment law has not changed substantially. They are very afraid that they are going to see your traditional discrimination suits filed by women, people of color, LGBTQ people, people with disabilities.
Our thanks to Simone Foxman, reporter for the Bloomberg News Equality team.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.